Ever wondered why cryptocurrency and taxes seem to form a complex puzzle that's difficult to solve? Picture this. You're in a maze with countless twists and turns, and every decision you make can lead you to a different outcome. That's what it feels like when you're trying to navigate the tax implications of cryptocurrency transactions. The world of cryptocurrency is evolving at a rapid pace, and with it comes a whole new set of tax rules and regulations. It's not just about knowing how much to pay, but also understanding what constitutes a taxable event. There are common misconceptions and challenges that many face when dealing with crypto taxes. Some believe that cryptocurrency is tax-free, while others are unsure about how to report their transactions. These complexities can make the task daunting, and that's why we're here. We're going to delve deep into these issues and more, breaking down the intricacies of cryptocurrency taxes. Stay tuned as we unravel the mysteries of cryptocurrency taxes. To begin with, it's essential to understand what exactly cryptocurrency is and how it's viewed from a tax perspective. Cryptocurrency, often referred to as crypto, is a type of digital or virtual currency that uses cryptography for security. This makes it incredibly secure and difficult to counterfeit. Unlike traditional currencies issued by central banks, cryptocurrency operates on technology called blockchain, which is a decentralized system spread across many computers that manages and records transactions. Now, how does the Internal Revenue Service, or the IRS, see cryptocurrency? Well, the IRS doesn't view cryptocurrency as a currency. Instead, it classifies it as property for tax purposes. This might seem like a minor detail, but it has significant implications for how your crypto transactions are taxed. Think of it this way. If you were to buy a house and then sell it later for a higher price, you'd have to pay capital gains tax on the profit you made. Similarly, if you buy cryptocurrency and later sell it for a higher price, you'd have to pay capital gains tax on the profit. This classification as property also means that if you use cryptocurrency to make purchases, it's treated as if you sold property for cash and then used the cash to buy goods or services. So yes, you could owe taxes even if you're just using your crypto to buy a cup of coffee. Why is this classification so important? Because it determines how you report your crypto transactions on your tax return. Just as with other property transactions, you'll need to keep track of when you bought your crypto, how much you paid for it, when you sold it, and how much you sold it for. These details are vital for calculating your capital gains or losses. Now that we've got the basics down, let's delve into the nitty-gritty of cryptocurrency transactions and their tax implications. When it comes to cryptocurrency transactions, not all are created equal in the eyes of the tax authorities. Let's dive right in and start with the most common type of transaction: buying cryptocurrency. If you're simply purchasing crypto with your standard currency, there's no immediate tax implication. It's akin to buying a stock or other investment. The taxman will only come knocking when you decide to sell. Now, selling is where things get interesting. If you sell your cryptocurrency for more than you paid for it, you've made a capital gain. On the flip side, if you sell for less than what you paid, you've suffered a capital loss. In many jurisdictions, these capital gains are taxable, and capital losses can be used to offset gains, reducing your overall tax liability. Trading one cryptocurrency for another is another transaction type that often surprises people. You might think, I'm just swapping one crypto for another, why would that be taxable? Well, tax authorities often view this as two separate transactions, selling one cryptocurrency and buying another. This means that a taxable event has occurred, and you could be liable for capital gains tax. Mining cryptocurrency is another area where tax implications come into play. If you're a crypto miner, the coins you earn are considered income at the time they're received. This income is usually valued at the fair market value of the cryptocurrency at the time it was mined. And yes, this income is taxable. There's also the concept of airdrops and forks, where new coins are distributed to existing holders. These events can also trigger a taxable event, with the new coins typically being considered income at their fair market value. Last but not least, if you earn interest through a crypto lending platform, this interest is generally considered taxable income. As you can see, the world of cryptocurrency transactions is a complex one, filled with potential tax implications. Understanding the tax implications of each transaction type is key to staying on the right side of the law. Record keeping is a crucial part of dealing with cryptocurrency taxes. Let's dive right into the importance of meticulous record keeping for all your cryptocurrency transactions. You see, the world of cryptocurrency taxes may be complex, but having a clear and detailed record of your transactions can make the process a lot more straightforward. Think of your records as a roadmap, guiding you through the twists and turns of cryptocurrency tax regulations. These records give you the precise details of your crypto journey, from the dates of transactions to the values in US dollars at the time of transactions, and even the purpose of those transactions. Now, you might be wondering, why do I need to know the exact date of my transactions? Well, the date can determine whether your gains or losses are classified as short-term or long-term, which can impact the amount of tax you owe. So yes, dates are important. And what about the value in US dollars at the time of the transaction? This is essential because it establishes your cost basis, which is used to calculate your gain or loss when you sell, trade, or use your cryptocurrency. And remember, your cost basis isn't just the purchase price. It can also include transaction fees and other costs associated with acquiring the cryptocurrency. Finally, jot down the purpose of each transaction. Was it a sale, a purchase, a trade, or a gift? This information can help determine the type of tax event that occurred, whether it's capital gains tax, income tax, or even a non-taxable event. But let's not forget about the importance of consistency. It's not enough to keep records only when you think about it or when it's convenient. Make record keeping a habit. It's a good practice to record the details of a transaction as soon as it happens. This way, you're not left scrambling at tax time trying to piece together the puzzle of your cryptocurrency activities. Accuracy is key in the world of cryptocurrency taxes. And when it comes to accuracy, nothing beats a well-maintained and detailed record of your transactions. So, gear up, crypto enthusiasts, because with accurate record keeping, you're well on your way to correctly handling your cryptocurrency taxes. Despite the best intentions, it's easy to make mistakes when dealing with cryptocurrency taxes. The complexities of digital assets and their intersection with tax regulations create a challenging terrain where even the most seasoned investors can stumble. One of the most common mistakes is not reporting all transactions. This is often due to a misconception that only profitable trades need to be reported. However, every transaction, whether it's buying, selling, or exchanging cryptocurrencies, needs to be documented for tax purposes. Even if you've only used your cryptos to purchase a cup of coffee, it's essential to note that transaction. Another common pitfall is misunderstanding the tax implications of certain transactions. For example, some people mistakenly believe that they only owe taxes when they convert their cryptocurrency back into traditional currency. The truth is, any trade that results in a gain, including crypto-to-crypto trades, is a taxable event. So if you've exchanged Bitcoin for Ethereum and made a profit, that's a taxable event, even if you haven't cashed out into dollars. Incorrect valuation of cryptocurrencies can also lead to errors. Cryptocurrencies can be highly volatile, and their value can change rapidly within a single day. It's important to record the value of the cryptocurrency at the time of the transaction, not when you're preparing your tax return. To avoid these mistakes, keep meticulous records of all your transactions. Use reliable software or apps designed to track cryptocurrency trades. Understand the tax implications of your trades and consult with a tax professional if you're unsure. Also, remember that tax laws and regulations can change. Keep up to date with the latest news and updates in the crypto tax world. This will help you avoid any unpleasant surprises when tax season rolls around. By avoiding these common pitfalls, you can navigate the cryptocurrency tax landscape more confidently. Remember, the key to successfully handling your crypto taxes lies in understanding the rules, keeping accurate records, and staying informed. As we wrap up, let's summarize the key points we've covered about cryptocurrency and taxes. Understanding the tax implications of cryptocurrency transactions is crucial. Every transaction, from buying and selling to trading and mining, has potential tax implications that you need to be aware of. The importance of record keeping cannot be overstated. Keeping accurate and comprehensive records of all your transactions will not only make your tax filing process smoother, but also ensure you're prepared in case of audits. We also looked at common mistakes to avoid, including not reporting your crypto transactions and misunderstanding the tax rules. These mistakes can lead to penalties and unwanted attention from tax authorities. The world of cryptocurrency taxes may seem daunting, but with the right knowledge and preparation, it's a challenge that you can confidently navigate. With this knowledge, you're now equipped to tackle the complex world of cryptocurrency taxes head-on. Remember, when in doubt, it's always a good idea to consult with a tax professional.